The operating performance of U.S. captive insurance companies rated by AM Best continues to surpass that of their commercial market peers. I'm John Weber for AM Best TV. With us to discuss AM Best's annual look at the U.S. captive industry is Dan Teclaw, an Associate Director in AM Best Property Casualty Rating Division. And Dan, given the sector's favorable results put against those of the broader PC industry over a long period of time, do you think the market is being used enough?
Hi, John. I don't know that it's necessarily that it's not being used enough, but we definitely think that there's more opportunity, whether it is in the type of coverage that a captive may offer or in a structure for different types of policyholders. As we noted in our report, the captives clearly outperformed the commercial market by about 15 points overall, with single parent captives, which are much larger typically, doing 25 points better, and RRGs, which are probably more competitive in trying to retain membership and having lower premium essentially, only outperforming by about 10 to get to the 15-point difference. But as we see in the still hardening market for various types of coverages, different types of captives can use different retentions, different definitions of what they want to include within their captive so that they ensure they're not taking risks that they don't necessarily want to include in there. Or if there are RRGs, they may be trying to expand ownership or do some ancillary coverage within there. And finally, we're seeing also opportunities for other structures in the form of cells. And the cells have been around, but they are effective and efficient for smaller types of potential policyholders, small businesses, small to medium enterprises. And it allows people to essentially risk share on a group basis and rent a captive, so to speak, without setting up a whole insurance company. There's some legislation out there in certain domiciles that may allow them to change over to a different type of entity if they want to keep the cell going after a long time. But in any event, those are the different opportunities that we see with regard to the opportunities from the outperformance in the market conditions.
Now, the report notes that the hard market is opening opportunities for captives, perhaps even in new lines of business. Is that of any concern for AM Best?
No, we don't think it's a concern. We expect that would happen whenever things harden and get maybe a little bit tighter in premium pricing, that companies may want to retain more on the inside of their enterprise. We highlight in the report actually that if you're not paying the commercial market, you're saving money for potentially a low frequency or high severity type of event in the future. And they've done this in the past 5 years to the tune of $3.5 billion in surplus increase and another $5 billion in dividends. So they basically saved $8.5 billion that would have gone to the commercial market had they not retained that inside. And they still covered losses to whatever they needed to. So no, we did not, or we do see other opportunities for them to expand in the cells that will also allow other companies to utilize them in anything from active shooters to small airplane to pieces of cyber and those type of things. MPL is clearly one of the ones that continues to be used. But it's a matter of what retentions the companies might want to keep in light of what we're seeing with regard to potential jury verdicts and those type of things.
Dan, you mentioned challenges within the market, and there are a number of them: cyber risk, reinsurance pricing, social inflation, just to name a few. Is there one that stands out to you as the biggest market challenge?
No, I don't think so. To me, the one that is easiest probably to overcome or measure and predict is the reinsurance pricing, since that's typically cyclical, and as capacity ebbs and flows, so does premium, and so that's easier to figure out if you're paying attention to the investment markets and world markets in general. But the other two seem to be more unknown quantities. Cyber risk, we've seen large ransomware attacks. We've seen companies get shut down on the Colonial Pipeline, and issues with over the COVID timeframe where there's more work from home, remote work environments where there are other access points for companies to get in and have insecure or less secure data that could jeopardize their company and basically have breach claims that are unknown in really the size that they might get to. And the same thing goes with social inflation, I think, as in regards to either MPL or even commercial auto in some regards, where there are jury verdicts that just come back to much higher levels than they had previously. So both of those are both challenges, but they're opportunities for captives who maintain their discipline of knowing what they'll keep within their captive, the retentions, and lay off some to the reinsurance market as they want to, or even keep it within the parent as much as the parent has both the capital wherewithal and appetite to retain some of that.
Dan, thank you so much for taking the time to speak with us today.
Thank you, John.
That was Dan Teclaw, an associate director in AM Best Property Casualty Rating Division. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.